assets, liabilities, debt, or whatever the result of business, the ledger balance, there are some rules which need to be followed. So it will, it will verify that this is there, bank statement, there are bills, there are vouchers. So the accounting is, we can say it is reliable. I hope no confusion till here. And then it provides analytical data. Analytical data means analytical reports. Analytical reports. What are that? Profit and loss account, or we can say income statement. Right? These are prepared. Then balance sheet is there. If you have question on what is balance sheet and all, that I'll be covering in the coming slide. Balance sheet is there. Then cash flow statement is there. Right? So these reports, these are the analytical reports. It helps the management, the lenders, the shareholders, the owners, or the employees of the business to take a healthy decisions regarding the company. So these reports are helpful for the management, for the lenders who will lend the money, for the shareholders who will invest in the company, for the owners who have started the business, or for the employee of the business. So it provides analytical data. These are the three main benefits which accounting brings. The data are verifiable, the data are reliable, and it provides the analytical data, analytical report in the form of profit and loss statement, income statement, balance sheet, cash flow statement. You will get to know about all these terms very soon. Right? Is there any query? Yes, GAAP we follow in India. GAAP US is also there, but everybody follow generally accepted accounting principle. There's a question, do we follow GAAP? Accounting has to be prepared. The reports are prepared following the principles, and these principles are known as generally accepted accounting principles. Here also we follow. If the company is big, they need to follow these principles. Benefit of accounting, you want me to explain again? Management accounting, you want me to explain again? See, management accounting is, I'll tell you again. Accounting is, it is a process. We record the financial transaction in a systematic manner. There is a way on how to record the transaction, how to prepare the report. That is accounting. Now, when we are preparing these financial reports, like when we are preparing the financial statements or balance sheet or everything, to present it to outsider, outside the company, for the external, means those who want to invest in the company, those who want to, invest their money in the company, or the customers, those who want to know the financial position of the company. So one need to publish the result in the newspaper. The company need to publish the result to the public so that they can attract the investors, they can attract the customers, everybody get to know about the financial position of the company. So when the purpose is to prepare the financial report for outside of the company, it is known as financial accounting. And these reports are prepared on the basis of generally accepted accounting principle. This is financial accounting. But when reports are prepared for taking the decisions within the company, right? The management want to take the decisions on expansion, on some, investment. So they need to understand that how their company is working, how the company is going, whether it is earning a loss, whether it is having a profit, or whether it is having a loss. So here the reports are prepared for taking the decision inside the company. That is known as management accounting. This is for within the departments, within the people, for higher authorities or for the management, they will take the decision. And this is for outside of the company. I hope it is clear now. There was a question on management accounting. Hope it is clear. Right? Cash flow and everything, I'm coming to that. Don't jump the gun. In the coming slide, I'll be covering everything. I have said already that please have a patience and listen to me very carefully. If you have a doubt on any terminology, I'll be covering soon. I have already mentioned the learning balance sheet of current year. You can compare the balance sheet of current year of a company with the previous year in order to know that how you are performing, right? From the previous year, whether you're improving or not, as per as long as the profits are concerned or financial records are concerned. So the data are verifiable. It can be compared with the competitive company as well, whether you are doing good from that competitive company or not. You can get to know through these financial reports. So data are verifiable and data are reliable. Reliable means, again, you can verify every asset, liabilities, debt, result of a business. How you can verify that? Through ledger balance. You will get to know what is ledger balance. Then bank statement, everybody knows it's bills are there. Through bills, you can verify the assets, liabilities, debt, and through vouchers. So this, the second benefits that accounting brings, the reliable. And the third is it provides analytical data. Analytical reports in the form of profit and loss statement, income statement, balance sheet, cash flow statement, right? So I'll be covering what is income statement, what is balance sheet, what is cash flow statement in the coming slide soon. Till here, if any doubt, please ask, and rest I'll be covering soon. Cash flow, I'll explain. Right? Now, first of all, I'll be coming to accounting principles. What are the principles which we follow? And then I'll cover what we say, vocabulary, or we can say the terms of accounting and the various account. So then it will be clear. First, let's pay attention here on what is accounting principles. Now, in the previous class, I have I've asked you to compare this accounting with the universe, as the universe has the basic law of nature which governs the universe. Similarly, accounting universe also has some principles which governs it. These principles are known as GAAP, I have already told. So these are some 10 principles which I'll be explaining, right? So first principle is entity assumption. Now this I have told you earlier as well. Entity assumption means business or a company is a separate entity, right? It is separate entity. Separate entity means suppose you are starting a business, so you need a resources to start a business. Now it is not a living business is not a living thing, right? It cannot acquire the resources on its own. Somebody has to give the resources to the business. So who will give the resources? Either owner or lender. Either owner or lender will give the resources, will give the money, will give the capital to start the business, and business has to return again to the owner or to the lender. So that's why there's an important concept here that business is separate from the owner. It's a separate entity. So every transaction, every recording, and every statement will be prepared keeping in this mind that business is a separate entity and the owners and the lenders have invisible claim on the asset because business has to return back to the owners or to the lenders. So owners have a claim on asset and lenders also have a claim on assets. Now owner's claim is known as capital, right? Owner's claim is known as capital. Now what is capital? That I'll cover in the coming slide. Lender claim is known as liability. Now what is liability? That again I will cover in the coming slide. So that's why what you need to pay attention here, entity assumption is a principle which says that business is a separate legal entity. It is separate from the owner. Someone has to provide the resources to the business to start a business. So who will provide the resources? Owner or lender. Either you will take loan from somebody or you are an owner, you have some money, you will put it in the business in the form of capital. Now you will claim, you have a claim, right? Invisible claim of assets of owners and lender. So owner claim is known as capital and lender's claim is known as liability. So here you need to keep in mind that business is a separate entity. Entity assumption says that business is a separate entity, and owners and lenders have invisible claim on the asset. I hope this principle is clear. Right? Now I'm coming to the next principle, which is, I'm checking the questions if you have. Okay. Now next principle is entity assumption. Now next is time period assumption. Now what time period assumptions say? That the result of the business, whatever result or whatever reports, we measure it for a specific time period. So companies are required to prepare the report either annually or quarterly. Right? They need to prepare the reports either annually or quarterly and published when required. Right? For particular time period, the reports are prepared, the results are measured. It might be for a quarterly result you will measure, or for annually you will measure the result. So there's a time period assumption is there, which every company has to comply with. Then going concern principle. Now this principle says that business will continue its business in the long run. Right? Business will continue for the long run, and there is no intention of the company to liquidate. And if there is an intention to close the business in the short run, then company need to mention it in the notes in the financial statement. While preparing the financial statement, there is a section for footnote. There, company need to mention that it will not be continuing, or it is having a loss. It will close the business in the short run. Otherwise, it is assumed that business will run for the long run, and the company has no intention to liquidate. Right? So this is going concern principle. These principle you need to keep in mind. This is very important. Then only you will have conceptual clarity. While recording the transaction, while preparing the statement, we need to follow the generally accepted accounting principles. So these are the main principles we need to follow. So listen to me very carefully. Right? So this is going concern principle. Then next is materiality principle. What is says? Materiality principles is that you need to, as company, need to mention everything, like every we can say specific information which is useful for the outsiders or for the shareholders. Just a second. Yes, any significant or information which is significant and which is impactful. Impact on what? Stakeholders and investors. So it needs to disclose it need to disclose what? Significant and impactful information. Significant and impactful information, and the non-essential data it has to exclude. Right? Because it can impact the judgment of the investors and stakeholders. So here the purpose is to prepare the financial statement which provides true and fair view of the company's financial positions and performance. So here every information which is significant, which is impactful, one need to disclose. As a company, one need to disclose it, which will have a significant effect on the judgment of investors and stakeholders. So that is the materiality principle, and the purpose is to ensure that financial statement gives a true and fair view of the company's financial position. So this is the materiality principle. I hope it is clear. Okay. Then you have the next principle, which is monetary unit assumption. Now, as the name is clear, that company should record those transactions which are measurable in the monetary terms, right? Only monetary terms, or we can say which are quantifiable. Quantifiable in terms of money. Only those transactions has to be recorded, which can be measured in monetary terms, and those transactions which are not quantifiable should not be recorded. That is the monetary unit assumption, because ultimately you need to understand whether there's a profit, whether there's a loss, how company is performing. So only those transactions which can be measured which have economic value, which can be measured in monetary terms, those transactions need to be recorded while preparing the reports. So this is the monetary unit assumption. Gap is not clear. Who is saying gap is not clear? Gap is generally accepted accounting principles. So I'm discussing here a few principles which we need to follow while preparing the account. Right? These are the principles which I'm covering here. So there are some rules which every company need to comply with. That is generally accepted accounting principles. Right? So these are the principles. First one was entity assumption, which says that business is a separate entity. It is separate from the owners and the lender, and owners and lenders. Assets have an invisible claim. Owner's claim is known as capital and lender's claim is known as liability. So it's a separate entity. Then time period assumption. Reports need to be prepared for some specific time. So companies need to prepare the reports either annually or quarterly, and they need to publish it. Then going concern principle, it says that it is assumed that business will be there for the long run and it has no intention to liquidate, right? So it will continue for the long run. All the reports are prepared keeping in this mind that the business will continue for the long run. Then materiality principle, one need to disclose the information which is significant and impactful, which can impact the judgment of investors and stakeholder. Here, the goal is to ensure that financial statement provide a true and fair view of company's financial position and performance. That is materiality principle. And then you have monetary unit assumption. So companies are required to record every transaction which can be measured in terms of money, which is quantifiable. The transactions which are not quantifiable or which cannot be measured in monetary term should not be recorded in financial accounting. So this is monetary unit assumption, right? I hope it is clear. Till here it is clear. Don't worry if you haven't attended the previous session, because I'm repeating it already. So if you have missed the previous session, no need to worry. Just listen to me very carefully. I'll be repeating these concepts, more often while solving the illustrations as well in the next class as well, because these are the concepts which will be repeated throughout your accounting course. So if you have missed or if it is not clear, it will, I'll be repeating it again and again. So no need to worry. Just listen to me very carefully. I'll try to resolve your queries here only, but still, if something is there, I'll resolve it soon. Don't worry. Right? So this is monetary unit assumption. Then we have matching principles. Now, what matching principle says that expenses has to match with revenue. Right? Expenses has to be matched with revenue. Now, this is based on accrual accounting. This is based on, just a minute. Accrual accounting. Now, what is accrual accounting? You might be having this question. Being erased. It is based on accrual accounting. Now, what is that? First, you need to know what is accrual accounting. So, when records are prepared, when statements are prepared, so companies follow. It is, as per the GAAP, as per the generally accepted accounting principle, companies need to prepare the reports on the basis of accrual accounting only. But few businesses prepare on the basis of cash as well. So what is the difference? I'll let you know. Accrual accounting is when revenue is recognized, when it is earned. Means regardless of when the cash is received, right? When revenue is recognized when it is earned, and expenses are recognized when it is incurred, regardless of when cash changes hands, right? For example, I have mentioned here. Here, sorry, why there are 2 points? Just a second. So here, revenue is recognized when it is earned, and expenses are recognized when it is incurred, regardless of when cash changes hand. For example, there is a sale of product on credit in January, but the payment is not received yet, till February. So here, one has to record the sale, the revenue in the January under accrual accounting, right? Even though the cash has not received yet. You have not received the cash, but the sale has been there. It is on credit, but it is there. So while recording the transaction, one has to show in the month of January on the basis of accounting, accrual accounting, that sale, this much amount of sale is there. So that is accrual accounting. Now, what is the benefit of accrual accounting? It gives accurate picture of company's financial performance, because when you are doing on the basis of cash accounting, what will happen? Company will record only revenue when cash is received and expenses when cash is paid. So that is known as cash flow statement. You will get to know how much cash is coming to the company or how much cash is going out of the company. It will not give the financial health of the company. When the accounting records are prepared, when the statements are prepared on the basis of cash accounting, it will not give the true and fair picture of accounting, because there are other factors which need to be concerned other than receiving cash or paying cash. So when the records accounting statements are prepared or accounting is done on the basis of cash accounting, here revenue is recognized when cash is received and expenses when cash is paid. So in the previous scenario, the example which I have given earlier, if there is a sale, you will record the revenue in February, not in January, because in January you have not received the money, you have not received the cash under cash accounting. So this is suitable for small businesses because they need to, pay attention to whether how much cash they are receiving and how much cash is going out. But for the big business, this is one of the things. So there they prepare the cash flow statement to get to know about the flow of cash within the business. So that is cash accounting, and accrual accounting is one need to recognize revenue when it is earned and expenses when it is incurred, regardless of when they receive the cash. So again, coming to the matching principle, matching principles means expenses has to be matched with the revenue, right? Expenses has to be matched with the revenue, and it is based on accrual accounting. Now I'll give you an example here. For example, there's a sale. There's a sale of 10,000. Wait a minute. Sale of 10,000. in the month of January. Right? Now to get this sale, company has to pay a commission of 1,000. So from this 1,800 is already paid and 200 is due. But here company will show the profit for the month of January as 9,000 only. Why 9,000? This, sorry, 1 lakh. Okay, sorry, 10. There's a sale of 10,000 and 1,000 for commission. Now from this commission, it has paid, company has paid 800 and 200 is still due. This 200 amount is still due. So here company has to show the profit. As per the accrual accounting for the month of January, company has to show 9,000 as profit, 10,000 minus commission. That 1,000 will be deducted and it has to show 9,000 as the profit in the month of January, although 200 are still due. That is, company need to match the expenses with the revenue, right? So that's why in the month of January, company will show profit as 9,000. Here 200 is still due. So this is accrual accounting and this is matching principles where one need to match the expenses with the revenue. I hope it is clear. I'll repeat again, don't worry. Right? So this is matching principle. Accrual accounting I have covered, cash accounting I have covered. Now the next is revenue recognition. Now what is revenue recognition? Here, this is again based on accrual accounting. So here, revenue is recognized when it is earned. Just a minute. Revenue is recognized when it is earned. Sorry. Here, revenue is recognized when it is earned, or we can say when goods or services are delivered. Right? Revenue is recognized when it is earned, or we can say when goods or services are delivered, not necessarily when cash is received. For example, there is a sale of rupees 10,000, right, in the month of December. Now from this 10,000, you have received 8,000. There is a sale of goods and services. This is sale on credit. Now from you have received 8,000, but 2,000 is still due here. But still, as per the principle, you need to show the sale of 10,000 here in the month of December, right? Although 2,000 is still due, but still, as the sale has already done, so revenue has to be recognized because it is earned. So company need to show the sale as 10,000 in the month of December only. This is again based on accrual accounting. So this is revenue recognition principle, right? So all the transactions, all the reports need to be prepared following these principles. Then we have cost principle. What cost principle says? That one need to show, company need to show the asset. Company need to show the asset on the basis of purchase price, the price at which the company has acquired the asset. And if there is an increase in the market price, the company need to ignore it. For example, company has purchased a land, right? This is on 1st March, right? Now on 31st March, what has happened? There's an increase in price, right? So here the company need to ignore this. this increase in price, and it will need to show the value of the land as 1 lakh only, right? Because it has acquired the asset on this price. So if there's an increase in the price, it need to ignore it. So asset has to be shown on the purchase price only. If there's an increase in the market price, that company need to ignore. Here the company has acquired the land for this 1 lakh. If there's an increase in the cost, that need to be ignored. It will show the asset on the purchase price only. So that is the cost principle, right? And then we have full disclosure principle. This says that all the significant information, financial information, has to be disclosed, need to be disclosed, right? Whatever the financial transactions are there, whatever the financial informations which can impact the stakeholders or shareholders, that need to be disclosed. Now, how it will disclose? There is a footnote section in the financial statement. So if there is an, change in accounting method, anything is there other than this, if there is change in accounting method, this need to be mentioned in the footnote, right? Footnote section is there on the financial statement. There they need to mention all the significant information. So if there is a change in accounting method, change in method, valuation of stock, or lawsuit pending against the company, every information company need to share through this footnote, right? So that is the full disclosure principle. So all the significant information which can impact the financial decision of anybody, company need to disclose that. So that is the full disclosure principle. And then we have this conservatism, which means that company need to consider all possible losses in a business, but ignore all possible gain. Whatever the possible losses which company feels that there will be there in the short run, that company need to consider. So company need to consider all possible losses, and for that provision need to be made, and it can ignore the possible gain, but losses has to be identified early, right? So accountant need to show possible losses under footnote in financial statement, but does not show possible financial gain. So these are the 10 accounting principles. I'll be repeating it again. In short, three main benefits I have covered. Okay. So let me repeat this again, the accounting principle. So there are certain principles which govern the accounting universe. These are the 10 principles which need to be followed while preparing the report or while preparing the financial statement. So first principle is entity assumption. It says that business is a separate entity from the owners and from the lenders, and assets have an invisible claim, right? Owner claim is known as capital and lender claim is known as a liability. The resources which we are providing to the business, that business has to return back to the owner or to the lender in the form of liability and owner in the form of capital. So it's a separate entity, and asset has invisible claim. Then there is a time period assumption. The reports or the financial statement has to be prepared for a specific time period. So either they will be preparing the reports annually or quarterly, and they need to publish it. Then there's a going concern principle. It says that it is assumed that the company or the business will go in the long run and it has no intention to liquidate in the near future. And if there is any intention to liquidate, it need to mention it in the footnote. So this is the going concern principle. Then we have materiality principle. Materiality principle says that the company need to disclose all significant and impactful information which can affect the decisions of shareholders or stakeholders. So that is the materiality principles. Then monetary unit assumptions, it says that a company need to record all the transactions which can be recorded in the, which can be, measured in the monetary terms, which are quantifiable. The transactions which are not quantifiable need not to be recorded in the, while preparing the reports. Then matching principle, it is based on accrual accounting. Accrual accounting, I've already explained that revenue is recognized when it is earned and expenses when it is incurred, regardless of when cash changes hand. So if there is a sale in the January, credit sale in the January, but you haven't received the full payment, still in the month of January, on the basis of accrual accounting, you need to mention the sale or revenue for that particular amount, whether you have received the cash or not. This accrual accountings are prepared on the basis of accrual accounting. It gives the accurate picture of company's financial performance and position, right? So it matches the revenue and expenses with the period in which they occurred. Cash-based accounting is revenue is recognized here when cash is received and expenses when cash is paid. So here, from the previous example, you will record the sale here in the month of February when you will receive the cash. So this is very simple to implement, but it is useful for the small businesses only. But according to GAAP, one need to follow the accrual accounting to prepare the financial statement. So here, matching principle says that expenses has to be matched with the revenue. For example, there is a sale of 10,000 in the month of January, and to get that sale, company has to pay the commission of 1,000. Now, from this commission, it has received 8,000, but 200 is still due. But here, in the month of January, they need to show the profit as 9,000. 10,000 minus 1,000 gives you 9,000. So that is the matching principle. This I've already covered. Now, revenue recognition principle, again, it is based on accrual accounting. It says that revenue has to be recognized when it is earned or when goods and services are delivered. So if there is a sale of 10,000 rupees and the company has received 8,000 and 2,000 is still due in the month of December, company will show sale of 10,000 only when on the basis of accrual accounting. So that is the revenue recognition principle. Then we have cost principle. Here, business need to mention the asset on the basis of purchase price, the price at which it has acquired the asset, right? So like if there is an increase in the market price, the company has to ignore that. And suppose company has acquired a land for this much amount, and on 1st March and on 31st March, there is an increase in that amount, but it has to ignore, it has to mention the price of the land at the purchase price only, the price at which it has acquired the asset. So that is the cost principle. And then put disclosure principle. So one need to, disclose all the significant information, any changes like in the accounting method or any, any lawsuit or any change in the method of valuation of stock, that need to be mentioned in the footnote. So that is the full disclosure principle. And finally, the conservatism principle, it says that company requires to consider all the possible losses in business, but it can ignore all the possible gain. So again, in the footnote, in the financial statement, company need to mention all the possible losses. So these are the 10 principles which you need to keep in mind while preparing the financial statement, right? So now I'll move forward for the next. That is the terms or the vocabularies of accounting. There are some terminologies which you came across while preparing the statement or preparing the reports or recording the transaction while going through the accounting. So first is financial statement. So what is financial statement? It is the end result of accounting. You record the transaction, you prepare the trial balance, their journal entries, their journal ledger, and finally these all exercise is to prepare the statement. These statements give the financial position of the company. So we can say these are the end result of accounting. So it will include income statement, balance sheet, change in owner's equity, and cash flow statement. So when we'll be solving the illustration, you will get to know how to prepare the income statement, how to prepare the balance sheet and cash flow statement. So that is the financial statement. Now, income statement, again, it show you the company's income and expenditure. So by looking at the income statement, you find out whether the company is making profit or loss for that given period. So income statement along with the balance sheet and cash flow statement. Not only the one statement, you need to understand the balance sheet and cash flow statement as well. It will help you to understand the financial health of the business. So that is about the income statement. And then balance sheet, again, it reflects the financial position of a company at any point of time. It will have assets, liabilities, and owner's equity. I hope these terms are clear. Right? Then okay. Next is asset. What is asset? It is something that has a value. We can say resources, and it is owned by a person, business, or organization. Now, there is a classification of asset, current assets, and non-current assets. So what are current assets? These are the resources that can be converted to cash within a year, within a 1 year of a time. It can be converted to cash. So these assets are known as current assets. Examples I have mentioned here, like cash and cash equivalent. Money which is readily available and easily convertible to cash. So that is current assets. Account receivable, money owed to the company by customer for goods or services provided. So that will also be the current asset. Then inventory, raw material, work in progress, and finished good held for sale. The moment there's a sale, it will receive the cash. So these are also considered as current assets. Then there are marketable security, short-term investment, we can say, that can be easily sold for cash. There are some investments for which you can have, cash within a very short period of time. So that are known as short-term investment. So these are considered in the current assets. Then we have prepaid expenses, payment made for future goods or services such as rent or insurance. That also comes in the current assets. Then supplies like unused materials and items that are expected to be consumed within the next year, right? And short-term investment. So these are all the example of current assets. These are the resources. Current assets are the resources which is owned by the person, business, or organization. There are two classification of assets, current assets and non-current assets. Current assets are those assets that can be converted to cash within a year. These are the examples of assets, current assets, cash and cash equivalents, account receivable, inventory, marketable securities, prepaid expenses, supplies, and short-term investment, right? Then we have non-current assets. Non-current assets are the long-term investment, and it cannot be easily converted to cash within a year, such as land. You cannot convert it into cash very easily. Property, plant, equipment, trademarks, and long-term investment. So these assets are known as non-current assets. Examples I have given here, tangible assets like land, building, machinery, equipments and vehicles, intangible assets, patents, trademarks, copyrights, goodwill. These are intangible assets. And then there is a long-term investment like bonds, shares, and other investment held for more than a year. So this is the non-current assets. Right? Then we have fixed assets. What are fixed assets? Are the property, plant, and equipment which help to carry out day-to-day business operation. Obviously, you will be needing land, building, or machinery to to carry out your business. So these are the fixed assets: property, plant, and equipment which helps to carry out day-to-day business operation. Then we have liabilities. These are the obligations, we can say, or debt that a company owes to other, right? And these are required to be paid in the future. That it required future settlement. For example, account payable, money owed to supplier for goods or services received. Then loan, you have borrowed loan from the bank or the other lenders that had to be repaid. Mortgages, loan secured by real estate. Then taxes payable, amount owed to government agencies, it is again a liability. Then salaries owed to employees, again a liability. And deferred revenue, money received for goods or services that have not yet been provided. So these are all liabilities, right? I hope the terms are clear. Earlier, many of you will have questions regarding this term. I hope it is clear now. Then again, there is a current liability and non-current liability. Now, current liabilities are short-term liabilities or debt, we can say, that has to be paid within a year or a normal operating cycle, usually less than 12 months. Like account payable, amount owed to supplier for goods or services purchased on credit. Then short-term debt, loans or debt that are due within 1 year. Salaries or wages owed to employees or contractors. Taxes owed to government. And accrued expenses, cost incurred but not yet paid, such as utilities or rent. Customer deposits, like money received from customers for goods or services that haven't been delivered yet. And dividends payable, dividend declared by the board of directors but not yet paid to the shareholders. So these are all current liabilities. These are short-term liabilities or debt or business expect to pay within a year or a normal operating cycle, and that period could be less than 12 months. So that is current liability. What is non-current liability? Opposite of, again, current liability. Here, the debt or financial obligation company expect to pay after 1 year. So these obligations are not due within the next 12 months. Like long-term debt, we have loans, bonds, and other debt instruments with maturity date beyond 1 year. Then deferred tax liability, they arise from temporary differences between taxable income and accounting income. So don't get afraid with these terms. When we will be solving the problems, when we'll be solving the illustrations, these terms will come again and again. So I'll be clearing this term in between that, problems or illustrations as well. So if you have any doubt, don't worry. We will come to this. I'll be repeating it again and again, right? Then deferred tax liability, they arise from temporary difference between taxable income and accounting income. Then pension benefit obligation, these are the amount a company owes to its employees for future pension payments, right? Then there is a long-term lease obligation. These are the obligations associated with long-term leases of property. These are just the example, right? Examples of non-current liabilities. So if anybody is new to these terms, we will get to, you will get to familiar with these terms very soon. So this is non-current liabilities. I hope it is clear. Then we have capitals or owner equity. In this simple term, the resources which owner provide, the money which owner provide is capital, or we can define it as amount of money invested by the owner in the business minus any money taken out by the owner of the business. For example, if real estate project is this much, 5 lakh, then the loan amount due is this. So owner's equity will be 1 lakh, right? It has to be deducted. So that is capital or owner's equity. Now, what is equity share capital? Here, when company is in need of fund or need of money, it raises the, it issues shares to the shareholders in exchange for the ownership. So here, the investor will get the ownership and company will receive the money, the capital to run the. So that is known as equity share capital. I'm reading out again from the slide. Equity share capital is the portion of a company's capital that is raised by issuing share to shareholders in exchange for ownership of the company. It is a type of financial instrument that allow companies to raise funds from the public. So that is equity share capital. I hope it is clear. Then income. Everybody knows it's an inflow of economic benefit which result in the increase of owners' equity, like income from sale of goods or provision of services, interest income, etc. Then there is an operating income, income generated from main activities of a business, like selling of goods or rendering of services, and non-operating income, income earned from activities other than main activity of business, like interest income, gain on sale of fixed assets. So this we will be covering more while solving the illustrations. Revenue, income, which business earn by selling goods or providing services. Cost is an expenditure which can be either an asset or expense, right? Like expense, the cost which is expired, it is incurred to earn revenue. If there's an expense, it will definitely decrease the owner's equity. Expenditure, payment for acquiring assets, it will reduce reduction of liability, repayment of loan or expenses. These are all expenditure. Revenue expenditure, the cost which one incur to generate revenue. So that is the revenue expenditure, cost of goods sold or rent expenses. Capital expenditure is there, cost which is incurred to acquire assets and includes cost which increases earning capacity of the assets. Operating expenses related to the day-to-day operation of the business, and non-operating that are not directly related to the core business operation. It includes interest payment, taxes, and losses from asset sales. So when we'll be solving these terms, then there is a reserve. It is a part of profit or gain that has been allotted for a specific purpose, right? When there is a profit, a company make a reserve of that profit or gain. So there are different type of reserves like general reserve, capital reserve, revenue reserve, statutory reserve, specific reserves, debenture redemption reserve, and secret reserves. Right? So it is self-explanatory. When you read this, you will get to know that reserve fund is created by keeping aside a portion of the profit earned by the business. Capital reserve, reserve created by accumulating capital surplus of the company. And revenue reserve created from company's profit. So it is very clear from the name itself. When you read, you will get to know. Reserve mandated by law to ensure that company can meet their financial obligation, that is statutory reserve. Specific reserve, reserve created for a specific purpose in the business. So it's explained in a very easy language. Debenture redemption reserve, you need to understand the debenture first here. So debenture again is a debt instrument issued by the company to raise a capital. Right? It's again a debt instrument which is issued by the company to raise a capital. So debenture redemption reserve, we can say, is a fund that company creates to repay debenture. Right? It's like a debt. So the company has to repay. So it keeps the debenture redemption reserve in order to repay the debenture. So it's a way to protect investor from the risk of company defaulting on its debt. So how it works? DRR is created from company's profit that are available for dividend payment. Then debenture redemption reserve can only be used to redeem debenture. And it is created to ensure that enough funds are available to meet the obligation of debenture holders. So these are all vocabulary. Then there is a provision for liabilities or losses, that is known as provisions, like amount set aside to cover future obligation or losses. So that are probable and can be reliably estimated. If there is a probability that there will be a losses, then the provision is made for that to cover that future obligation. Like potential liability or expenses that may arise in the future, such as bad debt, taxation, or warranty claims. So this is about provision. So these were the terminologies. Then while preparing the account, one need to open various accounts. There are various list of general ledger accounts which are numbered in a systematic order if you are following the computerized accounting. So these are the examples. I have explained that basically there are 5 types of accounts. All the accounts comes under these broad categories. These I have explained in the previous section: asset, liability, equity, revenue, and expenses. So these are all the accounts which we will open in the, we'll record or we'll uh, open in the general ledger, like cash, account receivable, bill receivable, inventory, office supplies. So I'll be explaining these terms when we'll be solving the problems. So rest I'll cover in the coming, in the next session. These are simply the terms which, we can cover while solving the illustrations as well. So these are the terms I've explained. What is account receivable? What is bill receivable? Like promissory notes or bills of exchange. Then there is an inventory. That again, when we'll solve the problem, it will be there. Inventory income is goods or a company hold for a sale, like raw material. There are various types of inventory: raw material, work in progress, and finished goods. So this is basically the inventory. Depreciation, there is a separate unit for depreciation, one separate unit, and there are straight line. There are various method of depreciation that we will be covering in the coming sessions. So complete unit for depreciation. So it's a lengthy topic that I will be covering in the next session. There are various methods: straight line depreciation, declining balance depreciation, unit of production depreciation. So first, instead of going for these terms in depth, you need to understand the principles and how to record the transaction. We'll start with the entries like journal entries, ledger, trial balance, that. And then only I'll be coming to these topic. Right? Retained earning. Let me explain the retained earning here. What is retained earning? Retained earning are the profit left over for business after it has paid out the dividend to its shareholder. So there is an option for retained earning, provisions. So these will be coming in the statement. These terms will be coming in the statement. So the decision to retain the earning or to distribute them among shareholder is usually left to the company's management. So a growth focused company may not pay dividend at all or pay very small amount so that it can use retained earning to finance expansion activities. If company has expansion planning in the future, it will have some, keep some profit aside. So that is the retained earning. So these retained earning company can use to increase production capacity, hire more employees, launch a new product, or share buybacks among other users. So these are important metric for assessing company's financial health because they show how much the company has saved over time and therefore can reinvest in the business or distribute to shareholders. So I'll be repeating these terms again. Dividend, it is a portion of the company's profit that is paid out to its shareholder. And then there is a cost of goods sold. There are direct costs, raw material, direct labor, manufacturing overhead. So there are a lot of things. These I'll cover in the while solving the numericals. So that's all from my side. So we'll continue in the next session. If any doubt, any question is there. I hope it is clear now. Right? So that's all for today's session. And in the next class, I'll be covering few more concepts, how to record the transactions, how to prepare the, trial balance, journal entries. Any question, any doubt, please ask. Okay, so that's all. And we will have the doubt clearing session as well. So no worries. If you are having any doubt, we'll resolve that soon. So see you all in the next session. I mean, and from the next, we will begin with the classes. This was not the regular syllabus class. From the next, I'll start from the unit 1, right? So I'll be repeating it again. These sessions were for to clear the basic of accounting. So I'll repeat it again. If you have still having doubt, don't worry. So that's all from my side. Thank you so much.
Thank you so much, ma'am.
Okay.
Shall I stop recording?
Yes, yes. Should I leave?
Yes, ma'am.
Okay. Thank you.